For those of you who don't know me, welcome to this webinar. My name is Robert Colville, and we're going to be talking about various trades we're in, how they're doing, as well as what is looking good on our watch list. Okay, so that is all crucial elements. And we're going to be talking a lot about identifying opportunities from many weeks away, but big trades with huge profit potential we'll be looking out for, and really kind of like doing a market watch list today. Okay, so those of you who don't know me, I run a brand called thelazytrader.com, which is dedicated to helping people who lead very busy and hectic lives and helping them trade from as little as 10 minutes a day. We have all of our coaches are accredited by the Society of Technical Analysts. We've got a great Forex Peace Army rating of 4.5 out of 5, and we have just been accredited by the CPD Standards Office, which is based in the UK, so don't worry, you're in good hands. But a little bit of information, if we haven't met before, I founded The Lazy Trader about 5-6 years ago, back 2012, but I've been trading ever since 2007. I've been a swing trader, and I still obviously continue to swing trade currencies, stocks and commodities. Since starting the brand The Lazy Trader, which is featured on FX Street, obviously, FX Empire, London Investment Week, Forex Peace Army, and many other publications, we've taught thousands of people to trade Forex trading, stocks trading, commodities trading for as little as 10 minutes a day. Now, the great thing about this style of trading is that it gives you time to do the kind of things that you've always wanted to do that you haven't been. Okay, so that's a sweet spot for us, where we can essentially make the most from the market from doing as little as possible from the market. Okay, so
anyway, let's move on to the trades. And we were in EuroCAD. We did very well on EuroCAD. Hopefully we're able to cash in a bit of the action here. For those people who weren't members of The Lazy Trader at the time of taking this trade, I'm just going to go through the how and why behind this classic setup, actually, ABCD setup on the daily time frame, because I know a lot of you have joined this week. For those people who do want, obviously, to revisit the original trade idea, it's in the trade ideas section under past trades. Okay, so this was essentially an opportunity to sell this bearish pin bar reversal at the end of an A, B, C, D pattern. Okay, it's like a thunderbolt. So we've got this here. Let me just draw it for you as well, so you can see it a little bit more clearly. There we go. Let's go A, B, C, D. And what is interesting about this one is the fact that we generally have complete symmetry between points A to B equals C to D. And what they do is they mark very good points where we can see a reversal in the market. We're going to talk about ABCD patterns a lot towards or later on in this webinar, okay, because they are absolutely everywhere. And when we combine them with key levels of support and resistance, they are very powerful. And I really want you to kind of like start getting used to identifying them. So you see, if you recall, points A, B, C, D, generally we get symmetry between A and B. You notice this that I've drawn here. And then C and D. There we go. Let's move it across. And typically what we get is the completion point where D is. All right. So this we generally use in conjunction with the Fibonacci level. Like, for example, if we see points A to B, typically it will interact with the 786, the 0.618, or the 50% Fibonacci retracement. But it's when we get the extension, that's when it becomes a little bit more interesting, because typically we'll get the reversal at the 1.272 or the 1.618. And if we get a price action based reversal in the form of our bread and butter signal, the bearish pin bar reversal in this case, then this gives us an excellent point or entry, confirmation, whatever you like to call it, in order to go short in this case. So what we did was we placed our order just below the low here, stop loss above the high, and then what happened, we just let the market decide our trade's fate. All right, so we were triggering into the trade quickly. For every second seller bar, that is a very kosher way to start trailing your profits. So I know a number of you actually started doing that, and that's absolutely fine. There are two ways in which you can do this. You can either scale out at a 1-to-1, or you can trail your stop loss behind the high of every second seller bar. So let me just get rid of this Fibonacci retracement here, and I will show you exactly what I mean. So we've got seller bar 1, seller bar 2, so move your stop loss here. Then we had seller bar 1, seller bar 2, move your stop loss here. And that is essentially that way of doing it. It's a very mechanical style of essentially managing your trades, where you can systematically bank profits and mitigate risk. All you could have done as well is the scale out at a 1-to-1. As we'll see here, this trade did make a 1-to-1 before suddenly reversing. Let's show you exactly what I'm talking about here, for those of you who are unfamiliar with how we did this. So we measured this bar in terms of pips, so it's about 77 pips in terms of difference between high and low, or entry and our stop loss. There we go, as you can see here. My apologies, it was about 70. There we go. So then we do it again, and as soon as we get down to 70 pips profit, what happens, like we did in the trade, we got down to about 75. So what we did was we bought half the position. As we're going short, we bought half the position, so we're able to take half our profits off the table. And that means that if the trade did go completely back and essentially hit our stop loss in its original place, then we would have lost absolutely nothing. We would have had a free trade. But we didn't let the market punish us in this way. So we scaled out at 1-to-1 at about this point here. When we risked 70 pips, we made 70 pips, so we bought back half the position, we moved our stop loss to break even here, and then we were prepared. We got some money off the table, and we were fully anticipating that the market can do anything like it does. The markets can do anything anytime, like I've mentioned many times before, and it's just as well that we did that, and hopefully you did that as well, as per our typical modus operandi protocol. The market had other ideas, and it's gone up. So it's so important. It's one thing to kind of like trade the daily and the weekly, and trade every so often with the lower frequency of trades, and benefit from that kind of like armchair trading. But it's pretty crucial to know exactly what to do, when to do it, when you're in the trade with the management. That's so crucial. Okay, so that is EuroCAD. I hope you managed to make some money from that. We're going to move on to some other trades which we were in. I know a number of you are still in the US dollar versus the South African rand. Good on you if you are. Let's just talk about this on the weekly time frame, because we did actually take that on the weekly. Surprise, surprise, it's a typical kind of like entry. This was a classic kind of entry in terms of a ring low formation on the weekly time frame. As you can see here, we had a bullish pin bar reversal, otherwise known as a ring low setup, on this kind of bottom side of this triangular formation. This is an area of indecision. Let's just go back a few weeks, because that's exactly when we took it, just to really kind of remind you of the actual setup. But if we look at the bigger picture here on the weekly time frame, we can see that the US dollar has essentially consistently done well against the South African rand, and that's no small measure down to the fact that in terms of politics, one could argue America is, but South Africa isn't in a very good place at the moment. But if you look at it from a technical perspective, you can see that we had the spike here towards the beginning of 2016. We retraced back 50% of the overall move, which is a psychological number. 50% Fibonacci is not necessarily a Fibonacci number, but it is a psychological line in the sand. When we've had a big move in any direction, whether it's up or down, and it retraces half of the way back, then we can reasonably expect it to move in the prevailing direction of the trend, in this case in an upward trend. So what we had in this case here was a bullish signal to go long in an area of indecision. This funnel here, symmetrical triangle, pendant, whatever you call it, is the fact that we've got higher lows and we've got lower highs. That is crucial, because it shows that, okay, lower high, lower high, lower high, high low, high low. And these are the points where we want to align ourselves essentially inside this before we get the potential explosion to the upside. As we can see, the prevailing trend is up. We've already kissed the 50% Fibonacci number. We've been making high lows since then, so we can reasonably expect, based on our understanding of technical analysis, at the apex of this triangle, let me just draw this for you. The apex of the triangle typically, well, will form around about here, but we can reasonably expect the breakout to happen 20% before the apex, so all the way up here around about this point, okay? And we were quite fortunate in this respect because we did actually get that. And let's just show you exactly what happened for the benefit of the people who weren't in the trade or joined after we took the trade. Bear in mind, we took this trade several weeks ago, quite some time ago. So we smashed up above it. We were able to take profit. We trailed below the low of every second buyer bar. So we look at every second bar here. We moved our stop loss from the low originally here. Our entry was here, and we moved our stop loss the first point here. At this point, mid-September, then we moved it here. We did scale out at a 1-to-1 also. So we scaled out here and took half our profits off the table and trailed our stop loss accordingly. Some people would go for the all or nothing outcome. I know a few of you were very, very adamant about the fact that the US dollar will continue to strengthen against the South African rand. But what is interesting as well is we had the US dollar reacting, retracing back. I know it was a very sharp retracement back to this trendline resistance prior to moving upwards again. And that's exactly what happened. And this coincided with 50% Fibonacci retracement of the move down, of the move up, moving down 50% before going up again. Let me show you exactly what I mean here. There we go. So it kissed 50% Fibonacci retracement, and that coincided with trendline resistance here turning into support. And we can reasonably expect the US dollar to continue in strength. So if we do get a pullback after a rally, then we'll look to buy the dip, essentially, an upward moving trend. So hypothetically speaking, now we've cleared this very long-term kind of period of chop and indecision, which has been going on ever since May 2016. What we're going to do is we are looking to simply wait for the extension to the upside, wait for a retracement, and buy around about here. Essentially, we're looking to buy the dip in the prevailing upward trend. We've had the breakout, and that's been confirmed. We've had the retest, which is the important thing. We've had the retest here, and we're just waiting for this high to be breached, and then we're waiting to buy the dip. Okay, so that is US dollar versus the South African rand. Right, let's move on to our watch list. There's plenty on this watch list. There's about 9 potential setups, which are at varying lengths away from potentially coming to fruition. So let's kick off with the Australian dollar versus the New Zealand dollar. We can see here that it's approaching a hard level of resistance. When I say a hard level of resistance, I'm talking about a level which hasn't been broken in over a year. And in this case, price hasn't been above this horizontal level since 2013. So if the Australian dollar does increase in value against the New Zealand dollar, it will be a very significant event. We can see that it's attempted to. It had a very big spike all the way back in August 2015. So treat this level with caution for those people who do trade supply and demand. So we're waiting to see how price does react to this horizontal level as and when it does get to this horizontal level. We can see here that we've got a shallow retracement. And momentum coming into this horizontal level is also very strong. The thing I don't like about it, if it wasn't for this spike here, I would be very happy to simply place an order to go short on this level and put it above the next highest point at where the market had broken out. But unfortunately, this spike is enormous, and given that the market, this currency pair, is not as liquid as the rest, we can expect to see more gaps and more irregularity when it comes to gaps. You can see all the gaps here actually throughout kind of August 2017, this year just gone. We can see gap 1, gap 2, gap 3, gap 4. and we had a gap here. So it's very gappy, it's quite irrational compared to many other currencies. So this is why I don't like it. The reason why I was drawn to currencies over and above stocks is that it's a level playing field, it's highly liquid, and the moves tend to be a lot smoother. Well, Aussie New Zealand tends to be the exception to this rule. So there are plenty of better looking potential setups on the horizon, so I won't waste too much time agonizing over this. But if we do get a price action based confirmation in the form of a bearish pin bar reversal with a reversal on a smaller time frame and or bearish reversal divergence, we could have it. By the way, looking at the RSI setting at 6, we've got this high here, and we make a higher high, which is inevitable at this point here, and we continue to have this lower high on the RSI setting 6. That is our confirmation that we've got bearish reversal divergence. Okay, so one for the watch list, the Australian dollar versus the Kiwi dollar. Let's move on to the FTSE, because this is getting ready. It's looking very toppy at the moment, and for those of you who've been with the service for any length of time, reversals are definitely our forte, even though you can reasonably expect to kind of lose more trades than win. That's the problem with reversals, but for those winning trades, you really do get rewarded very handsomely for it. So at this point here, we've got the all-time high in May 2017, the all-time high. Will it break the all-time high? That's yet to be seen. I know on the Dow we really are making new highs still, but remember, this is the FTSE, and we are in a relative stage of uncertainty with Brexit and everything like that. So the penultimate all-time high is actually as good a place to sell as the all-time high. For those people who've actually already sold on the level, the penultimate all-time high, based on the supply and demand strategy, that's a very valid entry. For those people who'd rather have a price action-based entry, then we are waiting for potential false breakouts. You can see that for the past week and a half, 2 weeks of trading, we've seen just sideways movement here. So we've got this kind of zone of congestion, this kind of box of congestion. So what we are waiting for essentially is a false breakout where we get, for example, the market poking its head above this level but closing below it in the form of a bearish pin bar reversal. So at least if we did enter this, at least we can get an efficient entry towards the top side of this box here. We can get an entry, and we can get an entry around about here. If we do get that false breakout bearish pin bar reversal with our stop loss nice and high above the point where last time the bulls dared come up to this point here, they're forced down by the bears, but essentially we'd far rather get an entry higher up in this box of chop consolidation than essentially an entry down at the bottom here. Let me just get rid of that, rather than an entry here, because as you can see here, we've got a bearish pin bar reversal here. That's all very well and good, but if we did enter below the low of this bearish pin bar reversal, we are entering essentially at the bottom part of this box here, and that's not very good. The price hasn't really escaped this box, whether it's up or down. We'd rather get an efficient entry at a point where we can essentially manage our position and mitigate against risk, or essentially protect any profits we make. Okay, so for those people who do want a price action based reversal, I'd wait for a bearish pin bar reversal, preferably a false breakout, where we can put our stop above all this noise here. Okay, so that is the FTSE. For those people who trade supply and demand, then of course we can reconcile the fact that this level here, the penultimate all-time high, is essentially a level of supply. The smart money are looking to unwind at the point where the FTSE really hasn't exceeded for a long time. Bar earlier this year, we had the all-time high. But reasonably saying, it makes a lot of sense if you're a value investor to realise profits at an all-time high or penultimate all-time high. What is interesting as well is it's very much in the FTSE's character to move sideways, and we made a lot of money, a lot of percentage points, and a lot of points and in 2014, 2015, when we had the benefit of a range-bound market. Let me go back and show you exactly what I'm talking about here, the FTSE. 2015, 2014, let's go back. Round about here, for example, you can see that this horizontal level right here really did kind of epitomise supply and demand trading where we've got, okay, test 1, test 2, we sold here, made a good amount of money. Test 4 here, we sold, didn't make so much money because it came back. Test 5, Test 6, we sold, made some money. Test 7, sold, made some good money. Test 8, this was around the time of the Scottish referendum, I believe. Yeah, it was around there. And this was a great move to the downside. So why can't it happen again? It's very much in the FTSE's character to kind of like range around all-time highs or penultimate all-time highs at the time of the ranging, okay? At the time, we didn't know that it was going to break to new highs up here. So this was irrelevant, quite frankly. But if we go back and consider this zone here, we saw that there was a good opportunity just to simply sell at the top of a range at a level which hadn't been penetrated in years. Okay, so I hope you kind of understand the logic here. It makes a lot of sense. And who says we can't do it again with the FTSE? It's looking very toppy. Interest rates are on, well, the Bank of England hinted that they're going to rise pretty soon. So that's not going to be good for stocks, quite frankly, because if interests rise, then investors are going to get better alternatives for investing their money. It becomes essentially more expensive to borrow money, so people can't just secure finance to invest in the stock market. Okay, let's move on. Kiwi dollar. Now this one has been through the wars lately, as you can see here. We have seen a very kind of like bearish week, doom and gloom. But that's not to say we cannot see an end to this doom and gloom. Let's show you exactly what I mean. And let's show you that we've got an ABCD pattern just forming at the moment, and ABCD patterns are good because they give us essentially a clue as to where the market could potentially reverse. Let me show you here. We've got our lovely kind of thunderbolt setup. We've got A, B, so let's draw it here, A, B, C. So D, well, it could be around about here. We're going to get the Fibonacci out in a minute for confirmation, but essentially for an ABCD pattern, we want this thunderbolt here. There we go. If we've got symmetry in terms of the gradient between A, B, and C, D being similar, then that's a bonus, a huge bonus actually, since the sign that's the momentum into the reversal area is going to be the same, and it's like a more of a known quantity. Okay, so let's do a Fibonacci projection, so we can see here that A to B, we've got a reaction with 618, that's fine. And do it from B to A, and we can see, okay, we've got a 1.618 Fibonacci extension there, that's fantastic. But let's see, do we get symmetry between the two levels? That's the important thing. Before, just drag it right here, point A to B. So there we go, near overlap there between the horizontal level, the 1.618, and the completion of the D point there. So this zone we're very interested in, and what we're going to do is we're going to wait for a potential bullish pin bar reversal on the weekly time frame, or indeed the daily time frame, and keep our eyes on it for potential long entry. Remember that the interest rate in New Zealand is far higher than it is in America. Well, I say far higher, is a bit higher, sorry. So if we do go long, providing we get the reversal, and our signal to go long at this point here at 0.6900, then we will be benefiting from positive carry. We'll also be at the bottom of a long-term range here. The New Zealand dollar against the US dollar has been range bound ever since May 2016, so for well over a year. Okay, so that is the Kiwi dollar. Let's take a look at euro sterling. On the weekly time frame, we can see that price has had a great response to this horizontal level here. We can see the movements of it have been very kind of whiplashy and quick. So this is on our radar for a potential test this year and a whiplash movement. I'm sure based on current news events, it will break eventually, but there's nothing to stop us taking advantage of the initial ping of this level here. Let's just get rid of that enormous big blob there. There we go. So we're looking at potentially selling price if, as and when it gets to this level. We're on the way up at the moment, it would seem. So we are just having an awareness for where price can potentially react to this level before going down again. Sure enough, it is an upward trend, has been since 2015. We cannot deny that. We've got good order, angle, and separation between these free moving averages, which of course is our objective measure. An upward trend with good speed and momentum behind it. But what the problem is with this one is the fact that we got to wait. And this is where patience and discipline comes into it, being one of the hallmarks for being a good trader long term, and survival in the market is absolutely critical. So we are fumbling around at the moment here, have been for the past 4 or 5 weeks. We've just come off this low here, and we are just waiting for it to come up to this level here. The great thing about this as well is the reaction or rejection of the level just above 0.9200 is that it's been very quick, very sharp, and very neat of the level. That's exactly what we look out for. So supply and demand traders who trade the power zone strategy, then this is the core profile of the setup that is in the offing. If you just wanted to have an order to sell on or just under the level with a stop loss round about here, that's good reward to risk. Actually, even if you did manage it and we did end up seeing price react or reject to this level here, and we did go down and make a higher low, at least you would have been able to scale out and bank some money at this point here. If it does go up again and break the level eventually, or continue down, you would be able to at least bank something and reduce the risk by moving your stop loss to break even or trailing your stop loss along the way. Okay, that's the nature of the beast. Okay, it's one thing to find these entries based on the strategy, and a lot of people spend a lot of time and energy doing this, but when it comes to actually managing the trade, when in the trade, they wouldn't know what to do next or tell you what they're going to do next, and that's the worrying thing. Okay, so let's move on. Let's move on to the Singapore dollar versus the Japanese yen. Now, this one is what we're waiting for is another ABCD pattern. So you see, when you know exactly what to look out for ABCD patterns, they're very straightforward to see. So as you can see here, we've got points A, B, C, and we're anticipating the D point. So let's write this down for you for your benefit. So you've got points A, B, C, and D. Well, we'll find out where D could be in just a second, okay? But the great thing about finding ABCD patterns and the easy clue, which I'd like to recommend to you, is looking for the higher low or the lower highs. This is the higher low. We've seen a good movement to the upside, nice higher low. And typically with ABCD patterns, like I mentioned, is that we get symmetry between points A to B. They typically equal C to D. But we need to confirm this with Fibonacci. So if we take points A to B, we can see that it reacted to the 50% Fibonacci retracement. That's fine. And then we take it down from points B to A, and we can see that 1.618 is round about here. There we go. Let's see if that coincides with a horizontal, sorry, a Fibonacci level to the downside. It does. The 786. And that could be actually a Gartley in the offing, actually, when we've got the 786 overlapping the 1.618, and we've got this formation here. That is a Gartley setup. And to all intents and purposes, we're looking for something like this for a Gartley setup. Let's move over to the downside, which we've had. High, low. That's A, B, we're at C, D, completing at 786 before sell to the downside. Because it's a 5-wave harmonic structure of Gartley, and you'll be learning more about that in due course, and that of course includes an ABCD pattern. So when you get to understand ABCD patterns, you'll see Gartley's, butterflies, and all these wonderful harmonic based patterns very quickly. But to all intents and purposes, this is on the watch list on a weekly time frame. We're many weeks away from it coming to our intended levels around about here, but hey, guess what, they're on the radar and they'll remain on the radar. Moving on to EuroCAD now, we are weeks away, or dare I say months away, from the completion of another ABCD pattern, and what we're waiting for is price to come to this horizontal level here, round about the 1.600. This would be a very decent level which to sell the euro against the Canadian dollar, but we just need to wait for it to come to this level here. And if you just think of trading as if you're like a huntsman in the woods sharpening his blade for a very, very long time, waiting for his prey to jump over the fence, we are setting our trap at the moment by having an expectation as to what the market could do, and we have our eyes on the levels. And when we're tracking the trade, i.e. our enemy, that's half the battle. Having an awareness as to where price could potentially turn in advance of the market getting there. So, as you can see here, we've got this movement to the upside, points A, B, C. Let's see where D can project. Okay, so we take measure A to B. There we go. And if we've got symmetry between the two, that's fantastic. Ah, yeah, great, we do. Right about this level here, which is a hard level of resistance. I mean, this level hasn't been broken since 2009. Remember, this is the weekly time frame. So this could be a fantastic point to sell the euro against the Canadian dollar and benefit from all this positive carry, given the interest rate in the eurozone is 0 and the interest rate in Canada is about 2%, I believe. So going back to the ABCD pattern, points A, B, C, D, where it completes at this horizontal level where price hasn't broken. You can see that price last responded to this level all the way down there, and then more recently, 2016, price went up here before going down, and we're just waiting for it to do exactly the same again. So we can expect, based on past performance or indeed behavior, that it will go down again. How far down? Nobody knows. But one thing is certain is that if we do get price coinciding with this horizontal level, it will coincide with the completion of an ABCD pattern, and that is extremely powerful, ladies and gentlemen, when we see the completion of ABCD pattern on a level which hasn't been broken, a strong level. There we go. Let's see, okay, how the Fibonacci works for this one. So you drag the Fibonacci first from points A to B. We can see that it's respected the 50% Fibonacci retracement. Okay, now we drag the Fibonacci down from points B to A, and we can see the 1.618, perfect, overlaps very nicely with or in the same zone as the level. So when I say zone, I mean that if things don't overlap perfectly to the pivot, it doesn't matter as long as it's roughly in the same area. That is the main thing. So you can see that the level is rejected here. The ABCD pattern completes there, and the 1.618 completes here. Okay, you've got a lot of wiggle room where to place your trade. I mean, whether you're a price action based trader or indeed supply and demand. If you're a supply and demand trader and you want to essentially preempt a level of supply here, i.e. people who are realizing the value at which to sell, people are holding euros and selling the Canadian dollar would look to sell around about here or just below the level. People who are a little bit safer on the price action based confirmation would anticipate and hope for, pray for, dare I say, a bearish pin bar reversal either on the daily or the weekly time frame. Of course, there is a risk that might not happen because the market doesn't really care about what you or I want. It will just do its thing regardless. And I've said this a billion times before, but it's absolutely true. We could just see, like we saw before, when the market did last test this level, it just shot up and shot down again. And this is one thing that you need to be aware of. The market could do that. So you don't want to miss the trade. So supply and demand traders, you'll be rewarded for taking the extra risk by having your sell order in the way of what could feel like an oncoming train. But hey ho, it's that old adage where there's risk, there's reward. And that is very, very pertinent. One thing that's interesting as well is this ABCD pattern. This market does seem quite prone to ABCD patterns because we've got one potentially forming there, but we've also got one, we've seen evidence of one happening before, prior to this one forming. From 2015 to 2016, we had A, B, C, D in the completion point. So it seems to be a bit of a quirk when it comes to this market. So points A, B, C, D. Okay, and currencies, various different currency pairs and asset classes do have their various quirks. Okay, so
that's a nice little selection as to what we are looking for on our watch list, and these are weeks away. Okay, so this is a great kind of like opportunity for you to really kind of take note and anticipate what could potentially happen next. And that's one of the most important things about trading. When a lot of people forget to do, they're so keen to be in the moment, and suddenly being in the trade now, when actually half the skill of trading is knowing when to stay out, identifying setups days, weeks, months even in advance of the setups occurring, and knowing what to do and when to do it when the market does what we expect it to do. Okay, because often the market doesn't necessarily do what we want it to do. That's absolutely fine. So that kind of nullifies our rules for entry, and it's a very important distinction to make. Okay, so we've got a good watch list. We've got the FTSE, we've got Singapore yen, Euro CAD, Euro Aussie, and Aussie yen as well. So I just want to ask you, how would you like to also transform your trading into a carefree, relaxing hobby? I mean, imagine if you had like a steady stream of trade ideas like this going to your mailbox every day, and you knew exactly what to look out for and when to do it. So that's the key thing. And it is possible. It's the difference between you working for your money and your money working for you. And today what we're doing exclusively with FX Street is we've got an offer where we're giving you access to our flagship Ultimate program valued at $1,997. We're going to give you a 1-month test drive for $30, and you'll get access to everything, including basic and advanced strategies, trade ideas, our forum, which is moderated, and you'll get access to all of the kind of like work modules, flip books, podcasts which we publish regularly. We interview other traders on our industry, and we have guest speakers. We also have proprietary pattern recognition software and a wealth programming hypnosis course. We've also got weekly and monthly webinars called Market Insider and Global View. So if you're not 110% happy, we'll always give you a refund. We've yet for someone to do this. So if you want to grab your 88% discount, get your place today. It's only valid until midnight tonight. Please do go to thelazytrader.com/forex-trading, and then by the Ultimate program, type in the code FX Street and hit apply. That will give you your discount to $30, okay, for your promo preview. All right, so hope to see you on the other side. If not, no love lost, but we have a thriving and rapidly growing community, and we really do have a good buzz at the moment in our membership. So if you want to get involved, by all means, take advantage of this offer. It's only until tonight, midnight. So there is a bit of urgency about it. But thank you otherwise very much for your time. If you have any questions, please do ask me and I will respond in the chat window. Otherwise, I'll say thank you very much for your time. Take care and happy trading.